Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. President-elect Donald Trump is being sworn in as the 47th president, pretty much as we speak. U.S. markets are closed today, of course, in observance of Martin Luther King Jr. Day. But all eyes will be on the markets to see how they react ultimately to the new president and his policies. Some executive orders expected either today or certainly tomorrow. Joining us here to set you up for the exciting trading week ahead is Fidelity Director of Global Macro, Jurrien Timmer. Warm welcome to you, Jurrien. How are you?
I'm well, thank you. Good morning.
Great to see you. I wonder if the term reset, which seems to be swirling around, is going to be the year's, word of the year. What do you think on everything that is resetting right now? We'll start perhaps with the political scene.
Yeah, absolutely. I mean, it's the dawn of another new era, and I remember the last time this happened back in 2016, 2017. And, from that episode, I learned to never be shocked by any outcome. And I think that's probably a good mantra to have for the second term, because it seems to be all gas, no brakes, and there's definitely some differences. I think President Trump has a much clearer agenda probably this time. I mean, in 2016, he kind of probably, nobody expected him to be elected, probably including him. So I think it will be, all gas, no brakes starting on day one. And you mentioned the executive orders. We're probably going to get a couple of hundred of those in the coming days. And, as is the case with this particular president or person, it's sort of, you have to watch what he does more so than what he says, because he likes to say a lot of things, especially on trade and immigration and other things. And so what actually transpires in the coming weeks, I think, will set the stage. And, we already had some potential good news here just today on a softer tone on trade and tariffs, and that's taking the U.S. dollar down, and so that's allowing the markets to breathe, because this is one of the known unknowns, right? I mean, trade and immigration are the two hot button issues that really have the potential to move markets, in a very big way. I mean, the other things we kind of know. I mean, we know about the deregulation, sure, the animal spirits. Those clearly are in play economically, as well as the markets and through rates. So we know what to expect there, more or less, and we know that extending the tax cuts is a priority, not only with President Trump, but the Treasury Secretary as well. And of course, one of the known unknowns there is how much of that will get paid for through a reduction in spending, because if that does not happen, those extended tax cuts will add about $5 trillion to the debt, which of course has to be financed, which the Treasury market doesn't like, and that's been a theme that we've discussed for many months about the term premium. And that is the other known unknown, right? So we know the Fed has cut rates by 100 basis points. It's not that far from neutral, at least my estimate of neutral. And if we go to slide 9, we can see where the Fed is. The Fed's at 4 3/8, which is a range of 4 1/4 and 4 1/2. The Fed's sort of terminal rate estimate is 3, which to me is too low. And the various inflation gauges that we follow, and we got CPI last week, which came in, kind of as expected, and the core PCE more or less as well. So core inflation running around 3. You add 100 basis points to that, you get to a neutral rate of 4%. That's exactly where the forward curve is, which is the dotted line there. So the market, I think, is in the right place. And I think the Fed is more or less in the right place. They have a couple of rate cuts sort of on tap for this year, but they're also saying that until inflation moves decisively again in the downward direction, they're in no hurry to give the market those rate cuts. And the market is not really, waiting with bated breath for those rate cuts, because the economy is pretty strong. Right. But what happens at the long end of the curve is more important, and that's the bear steepener that we've been talking about for some time. And we got some relief on that front last week with the 10-year yield going from 4.80 back to about 465. That sparked a monster rally towards the end of last week, and it just highlights how sensitive the market is to long yields at this point, much more than what happens to short rates. And so long yields, the term premium, the shape of the curve, are going to be some of the defining things for the market, just as trade and immigration policy will be.
Okay, well, we'll come back to some of those things that are impacting markets deeply. You mentioned, I mean, the 10-year, the concern is that bonds essentially compete more readily for equities, essentially. And so equities being, in some cases, depending on how you're measuring it, at lofty levels on the valuation front. Is there a competitor?
Yeah, and I think that's a very good and sort of easy way to think about it, as well as the correlation between bonds and stocks, right? The correlation between bonds and stocks has been negative for several decades, and that was mostly because yields were ultra low because of the heavy hand of global monetary policy, quantitative easing, zero rate policy, even negative rate policy. That was all designed to suppress the term premium on bonds. So, and the term premium is basically a risk premium on long bonds, just like there is an equity risk premium on equities. And that risk premium was repressed by central banks. That pushed yields way down to 1-2%, and that removes what we consider to be the risk-free asset, treasuries, as a competitor to stocks. And this is where the TINA trade came from. There is no alternative. But now there is an alternative because the yields on the risk-free asset have reset, to use a term you just used, and are now basically at the same level that the yield is for the S&P 500. Both assets yield about 5%, and cash yields about 4.5%. So so safe assets are very competitive, and as they get more competitive, it forces the stock market to remain competitive too. So if by definition, via the Fed model, if the yield goes up and it's at near the levels or even higher than the levels of the stock market has no choice but to adjust its valuation. And then it's a question of how much are earnings driving the bus, and how much is that reset in valuation taking away from that. And of course, in 2014, we had a very robust environment where we had good earnings growth of about 10%, and we're in the middle of fourth quarter earnings season right now. And valuations added another 2/3 to the return. And actually, one way to kind of illustrate that is on slide 10, which is an investment clock, where I show four different quadrants, depending on, depicting whether earnings are growing or contracting, and whether financial conditions are loosening or tightening. And so last year we were in the upper left quadrant, which ironically is the same place we were in 2017, which was the first year of the first Trump term. And so you had that tailwind of improving valuations, adding to the earnings growth story. I think this year, and we can already see that black line going into the upper right quadrant, we still have the earnings growth, and maybe it even accelerates, who knows. But at this point, valuations are high. They've already expanded. The dollar has strengthened a lot. Yields have risen. So these are all components that then kind of swing financial conditions in the other direction. And again, that doesn't mean a down market, but it means a less up market, and maybe a market that is more prone to occasional corrections. And even in the last few weeks, we got a 5% correction, which of course is a nothing burger in the grand scheme of things, but it's still a correction, and it's one that has been highly sensitive to changes in rates. So I think 2025 may end up looking more like 2018 than 2017.
That's so interesting. And you used the word ironic, that it was the first year of the... It seems like ironic is the right word, because so many other things happened in there, including COVID, including weird moments in a business cycle. So it really is hard to compare them exactly, but that's very interesting. Tell us a little bit about, within the valuation story, where you go to look for it. Do we look back at breadth coming in, for instance, cap weighted, versus taking a look just at different ways of measuring the market right now that might have other opportunities to get in at? What are you watching closely there in terms of breadth?
Yeah, so why don't we go to slide one? Uh, and again, the end of last year, we saw a pretty notable deterioration in the breadth stats, right? So here we got the S&P cap weighted index, still a beautiful chart, uptrend, rising trend line. Everything looks fine. The percentage of stocks in long-term uptrends or above the 200-day moving average is shown in the bottom. That went from 82% to about 50% very quickly, and that kind of took me aback a little bit that it was that easy to give up that broadening. We're back up to 61%, which is not great, but it's not terrible either. And you do see some divergences there where those arrows are, right? So this is not a perfect indicator at all, but as bull markets mature, they tend to narrow. And of course, this has been a really weird cycle, right? Because this bull market, which started in 2022, started narrow, then became broad last year, and then is sort of a little bit neither here nor there right now because it sort of rebroadened last week. But you see that as the cycles mature, price still makes new highs, but the breadth makes lower highs. And again, very hard indicator to time. Sometimes there are false alarms, but we are seeing something of that nature. And that's something that I'm keeping an eye on because you do want that participation to keep on going. And if we go to slide two, that's the equal weighted index. You can see that a more meaningful correction happened there since the middle of December until now. Still an uptrend, still higher highs, higher lows. So it's still a good chart. And actually, what could be encouraging is if you look at the percentage of stocks above their 50-day moving average, which is in the bottom panel, you can see that the market actually got quite oversold last week. And you don't really saw that in the S&P cap weighted because the Mag 7 didn't really trade down that much. But under the hood, again, a lot of the action's taking place in the broader market. And so we went from, 71, 84% above their 50-day to only 17% above their 50-day. And so that is a sign that the market, it's a bad sign that so few stocks are above their 50-day, but it's a good sign that, that is an oversold condition. And typically, oversold conditions in uptrends are ones that you can buy without too much regret later. And just to add one more thought to that in slide 3, that's a daily chart of the S&P 500 equal weighted index, and there you see, and this is kind of inside baseball technical jargon. But you see how the market moved down, then it kind of bounced around, and then it made a lower low. But the lower low was rejected, and the market recovered and is now kind of breaking out of that little range. And at the same time, the percentage of stocks with new 52-week lows made a higher low than the first low. And again, that is a bullish divergence. Again, very short-term daily chart. Like I wouldn't make any portfolio rebalancings on this basis. But it shows, again, an oversold condition, a technical signal that chartists always look for. And of course, now we have a positive headline story about a less onerous, a less heavy hand on tariffs, and the dollar's now coming down, which is something that's important as well to kind of release the animal spirit. So maybe that 5% correction that we got is all we're going to get. But again, like we did last year, I want to see this market broaden because if this is a true earnings-driven bull market where earnings are doing the heavy lifting, and we know they're doing it for the Mag 7, but we really want them to do it for the entire market. And maybe with that, and I know you're going to ask about it, so I'll beat you to it, but if we go to slide 4, I'll just comment that earnings season is now underway. 42 companies have reported, which is not even 10%, so it's still early. But about 87% are beating by about 10 percentage points. So far, so good. It's the financials that tend to report early, and that's been a very good story, as you would imagine, right? Because the yield curve has now uninverted, is now becoming steep, which banks like. And even though short rates remain pretty high at 4 3/8, the average deposit rate on banks' checking accounts is only 0.5%. So banks, at least the big ones in the US, are enjoying a very steep yield curve with very, very cheap funding, because those deposits, of course, is what funds the bank's loan book. And then you can see in this chart that the growth rate coming into earnings season is about 8%. You typically get a bounce of 3 to 5%. That's what we got the last couple of quarters. So very likely that Q4 will end up being a double-digit quarter, and that 2024 as a calendar year will be around 10%, with 2025 expected to be 10 to 12%. So the fundamentals of earnings, profit margins, business activity, the consumer being employed, wages keeping up with inflation now, debt levels not being a problem, at least not in the US. So economically, the story is good, and the earnings are there to show it. And then really it's just a matter of what happens to rates and how much does that eat into the valuation side.
I mean, it's a positive story, as you point out there, from the equities backdrop and what kind of year it's been and what kind of year we're going into. A couple of questions to cycle back to things you hit on before earlier, bonds, and also the overall inflation story. But the question is, what are your thoughts on the recent surge in bonds?
Last week, yields surged
Bonds went
all the
down.
way up to 4.81% last week, and then we got the CPI report that clearly people were bracing for another disappointing report, which did not happen. It came in line, but it was not like a bad report in terms of expectations, and bond yields fell like 14% that day, so we're back to the 460s somewhere. But I think the action was very, very telling, because the market is hypersensitive to changes in yields. And again, if the 10-year Treasury yield was at 2.5 going to 3, stock market wouldn't really care, right? Because 3% does not compete with the stock market that produces an earnings yield of 5%. But at 4.5, maybe going to 5, bonds are competing. So the level from which they are rising and to which they are rising is very, very important, more so than the amount that they are changing, right? We know that, like, for instance, when oil prices go up, it's less about the level of oil prices and more about how much they change and how quickly they change. But for yields, it's really the opposite. Obviously, the amount that they change is important as well, but it's really the level. And the fact that we are sort of approaching 5% or did approach 5%, and that the market was laser focused in both directions of that, shows you that 4.5 to 5 is sort of the yellow zone for bonds. Certainly 5 and above is the red zone. I think if yields were to go to like 5.5, stock market would have a tough time. And you mentioned inflation, or the question mentioned inflation, and that does remain a big story for 2025. I don't have an inflation chart. Well, we can put slide 9 back on, I guess. But my worry is that the economy, so if we don't know what happened to inflation in 2022, the CPI went to 9%, the core rates went to about 5.5%. They've come down, which of course is great news. I mean, it may not be a lot of solace to the consumer who, is just seeing prices rise at a lesser pace. Prices, it's not like prices are going down, but they rarely ever do. But at least the rate of change has come down. But it's still above the Fed's target, right? The Fed's target is 2. We're at 3, which is better than 6. But if the economy went from expansion post-COVID to a slowdown, kind of soft landing last year, and if it is now going to reaccelerate because of animal spirits, deregulation, extended tax cuts, what have you, I worry that the inflation genie wasn't quite put back in the bottle all the way, and that if we now have another wave, not like a wave like we saw after COVID, but even a wave, where inflation goes up because, again, more activity, it would be going up from a higher baseline, and that would be bad, because then the longer term average, which I'm showing here, like a 2-year or 5-year average, that's already above 3%. And then that would stay above 3. And then the Fed is looking at a long run inflation rate that is well above its target. And that would affect A, how much the Fed can ever ease, and B, it would affect the term premium on the long end. So that is another very big known unknown, which of course is tied to the term premium and long rates, as we were discussing earlier.
You mentioning there, and in other days, and some of your colleagues as well, this idea of bond volatility, the price or the yields. I mean, it's the same story, it's just down the side. From last week, Tuesday to Wednesday, we had the PPI and then the CPI, and it was that crazy seesaw, but all within a range. Now, the range is tricky because it can hit 5% on the yields side, or that's the concern. But do you take comfort in the fact that it's vol within a range?
Yes, to some degree. And actually, if we go to slide 8, we can kind of illustrate that in the bottom panel is the real yield. So that's the nominal yield minus the TIPS break even. And we can argue whether the TIPS market is an accurate depiction of where inflation is or has been or is going. But you can see that the entire post-COVID market has been sort of defined by real rates. And you can see the VIX at the top, that this latest episode wasn't quite as elevated, and that really big VIX spike that we saw last year had nothing to do with real rates. That was the yen carry trade that unwound back in, I guess, July it was. But all the other vol events in the stock market seemed to be associated with rises in real yields. And so, but in that sense, to your point, right, the real yield is 2.3 right now. In the fall of 2023, when the yield went to 5%, and that caused a 10% correction. At that point, the real yield was 2.5. And all the other times, it was, again, 2.3, in that area. So yes, it has been a range in that sense. So real yields have not broken out. And so unless inflation expectations start elevating, right, because you think the nominal yield is the sum of the real yield and inflation. So nominal yields can go up for one of two or both reasons. But right now, it's all been based on the real yield. So you could be in an ironic situation where the real yield doesn't really go up anymore, but that the inflation expectations do. But that so far has not happened. So it has been contained in a range, and again, 4.5 to 5 is that yellow zone that the stock market says, whoa, we're paying attention, and so far we haven't gone beyond that. But I do worry that you look at animal spirits, you look at how powerful the actions are from the now new White House, and how serious Donald Trump is on getting this machine going again and releasing those animal spirits through tax policy, deregulation, trade, whatever. You could see a scenario where instead of kind of this malaise of stagnation and the old days of secular stagnation where inflation was really low, but so was growth, maybe we get a boom, and maybe that boom is not so great if it leads to kind of an unsustainable combination, like tinderbox of rising yields and a very strong dollar and things like that. And again, I'm not predicting that. It's not happening right now, but things can go in all kinds of directions. And again, this administration seems to be all gas, no brakes. And you see that on the crypto side. I mean, Trump has a meme coin. Now Melania has a meme coin. I mean, we're make this stuff up, and I think we just need to get used to that in these next 4 years.
So there might have been some very quick party hats put on in Canada over the calming down of the Trump tariff discussion. It might have been very quick, but again, that's probably an example of what you're saying. There's sort of this push and pull. So in your mind, is there anything you can point to us getting used to lots of tariffs, push and pull? Like, can we breathe a sigh of relief at all, or is it just for today?
It's the art of the deal, and I'm glad to see that he's not levying tariffs on day one, which wouldn't really make sense, right? I mean, he wants to get the best. It's America first, and he wants to win, right? I mean, for himself, but presumably for the country as well. And so if I were him, I wouldn't do tariffs on day one, because you want that as the stick and the carrot at the same time. And, I don't know why anyone here would target Canada, because we're such big trading partners. But China is obviously a fair game, and China, trade with China gets manifested through Mexico sometimes, and so that is somewhat fair game. But why he would pick a fight with our kind neighbors on to our north is beyond me. So maybe this is all bluster, and like I said before, watch what he does, not what he says. And so hopefully cooler heads do prevail, and that we'll see a more thoughtful approach, not just on trade, but on immigration as well, because rounding up millions of people and deporting them, wherever your moral convictions may lie, would be highly disruptive economically, and it would be inflationary, because in part, the increase in immigration, whether legal or illegal, has helped calm inflation down, because the inflation was in the labor market as well as on the grocery store shelves. And so it's important to do that in a thoughtful way, because otherwise the labor market gets unbalanced, and then we are looking at 4% inflation again, and that creates a whole other set of problems.
You look at global macro. It's in the title of your it is your title. Do you look to China later on as being an interesting place to invest? I ask because there's a lot potentially priced in to Chinese equities, particularly, and there's a lot of uncertainty there. But you wonder, with a little lightening of uncertainty. What do you think?
I think China is, I think it will work from time to time as a cyclical story, but the U.S. works as a secular story.
Right.
I mean, that's the AI, the Mag 7. And China, in some ways, is sort of where Japan landed in the 1990s, right? I mean, China grew too fast, and they did it by issuing a lot of debt. And when you issue a lot of debt, you get misallocation of capital, and especially when it's state control, right? If you tell capital where to go, it's going to land in the wrong places, is an old saying. So they overindulged, if you will, in growth at the expense, using debt, and then you're borrowing from the future. And Japan, in many ways, did that in the 80s, of course. And so it's just a question of how they deal with the hangover of that debt. Now, China is not the same as Japan, of course. But so I think in China, you're going to get big moves from time to time, depending on how robust the stimulus is. What we saw, of course, a few months ago really didn't have any teeth. And so the Chinese market has sort of remained a little bit in limbo there. But I think China is a market where you want to rent stocks and not own them, if that makes sense, where you're in for a trade, but you're not in to close your eyes for the next 10 years. So you have to be nimble. And it's like buying value stocks or banks or cyclicals in North America. So I think that's how I would sum up China. It's like, India is a secular story, more like the US, because they're doing a lot of things right. China is more a deep value play where you'll see a reflation, you'll see a weaker dollar translating, and you'll see some real stimulus there, and you'll get a trade, but you don't want to overstay your welcome.
Fantastic. Jurrien Timmer, we're so grateful to speak with you every Monday, but particularly on Inauguration Day. Thank you for setting us straight and putting our feet on the ground here. See you soon.
Thank you very much. Have a great week.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.